the FOMO, I basically have Anthropic saying they're building God, right? So what is God worth from valuation point? And everybody and their mother is like, I don't want to miss out on investing in the next God of Earth. So every VC family office is trying to stuff money into AI, but crypto's kind of being ignored right now. We have the expertise, we have the networks, the edge. And the valuations have plummeted to a point where it's significantly easier to have a big return for your fund.
Welcome to the Gate Ventures podcast. I am your host, Jeremy Wallis, and today we have an incredible guest, Jed Breed, the founder and GP of Breed VC. Welcome, Jed.
Thanks for having me.
Of course. My first podcast, so I'm excited for it. I think you're one of the OGs in crypto. You started out mining in 2014, ended up as head of digital assets at Circle, helping launch USDC. Then you ran a DeFi hedge fund, and now you're a VC. Most people in crypto have had one of those experiences. Could you just walk us through that journey, and what is an anecdote from each experience that has stuck with you?
Yeah, it's great to be on the podcast. It's 2026 now. I got into crypto in 2013, so it's been 13 years and I'm still here. I've lasted all this time and been through multiple cycles, but yeah, I got into crypto back during that Bitcoin bull run back in 2013. I was living in Boston and next to MIT, and a bunch of folks from MIT started mining Bitcoin and Dogecoin and a bunch of other altcoins, and basically started as mining with some mining hardware first out of my bedroom, and we scaled up a little bit. What was kind of interesting, which I kind of wish I made a different decision, is I ended up spending way too much Bitcoin on sushi dinners. There was a place called Thelonious Monkfish in Boston.
Great spot.
Accepted Bitcoin. And now that sushi restaurant is 4 times the size and they have a grand piano in there. So they did pretty well on accepting Bitcoin that early. But yeah, so basically I've been in tech since 2009. We started mining, basically doing crypto as a side hustle. 2014 was really early and excited about Ethereum. When the white paper dropped, I became like an evangelist and community member of the Ethereum ecosystem. And fast forward to late 2017, during this time I'm just like trading and researching the space and getting excited. I sold my company in late 2017, and that's when I decided I want to go full time into it. So I joined Circle as the head digital assets. And that was kind of like where a lot of my network was kind of seated and where I learned a lot. My kind of thing that I really focused on, and I guess the claim to fame, was my team and myself. We launched USDC back in September 2018. So USDC is now, I think, $75 billion AUM. Everybody knows it. Circle's gone through lots of different iterations, and now that's really focused on USDC. Happy to talk about Circle days, but post-Circle, I joined Accomplice VC. I managed their DeFi liquid fund, doing DeFi yield farming, basis trading, that kind of thing, basically doing market neutral strategies. And then I started my fund, Breed VC, 4 years ago.
That's great. And why don't we start with Circle? Is it fair to compare the Circle Mafia to the PayPal Mafia in the Valley?
I would say it's not fair yet, but yeah, it's
a couple more years.
There's a bunch of us doing really interesting things, starting companies. You gotta remember, Circle's been around since 2013. It's had many iterations, many employees, lots of turnover over the years. And yeah, like it was crazy the days of launching USDC. Obviously Tether was out, and basically the strategy, there was a regulated stablecoin that was missing from the market. And so I think a lot of different firms saw that at once. And so before we launched, we were working on it for like a year. And it was a very big process to get that thing out. There was all kinds of compliance issues. And then back in September 2018, 2 competitors launched. And I'm not sure if you remember them. There was Paxos. They launched a US stablecoin, just like USDC. And then Gemini launched their stablecoin. So those 2 launched in early September. We were like kind of dragging our feet. We're really nervous about compliance. And then we said, we got to do this. So we launched in late September of that year. And then after that, we just really focused on a lot of different things, on partnerships, getting integrated in DeFi. One of the things that was like most instrumental was our partnership with Coinbase that we did that fall. So I'd say like that was pretty instrumental in our success on joining forces with the 2 largest companies in the space to launch it.
Would you say that was the biggest inflection point in that journey while you were launching USDC? Was it that partnership with Coinbase that really took it to the next level? And left the competition in the dust, or were there other key moments in those early days to the growth of USDC?
Yeah, I would say that was one of the key moments. Coinbase has massive distribution. It's kind of interesting. Even like the USDC logo is that Coinbase blue. So they wanted us to change the color, which is fine. And they really helped put on the map. I'm not sure USDC would be what it is without that partnership.
That's great. You ran Accomplice's internal DeFi market neutral fund from 2020 to 2022. Very exciting time to be in DeFi. What did running real capital through DeFi protocols in that era teach you about how they actually worked and how they could fail miserably?
Yeah, it was pretty Wild West times. We had DeFi summer 2020 and crazy bull market until kind of Luna collapsed. So we had 2 crazy years, as we all remember. We started with I was really into it on my personal account, these farms and all that kind of stuff. And Discord channels, like Synthetics had a killer channel called Degen Trading, and they would give all kinds of alpha there and new farms and stuff. And so brought that over to a more institutional aspect at Accomplice, and numbers significantly increased. It's pretty, obviously very high risk, and we always did an incredible amount of diligence and technical diligence, and we were fortunate enough to not have any hacks or anything. And so we did actually perform quite well. There was a lot of low-hanging fruit, to be frank. There are a lot of high yield type of opportunities, and the market was super frothy. So there was an opportunity to make great returns with, obviously there's always smart contract risk, but typically market neutral risk.
Would you say that was the key metric you focus on, was security and smart contract risks? DeFi summer felt like anything you threw money at, you could get a great return. What were the diligence process in those early days, and how did that evolve?
Yeah, I think it's actually kind of similar to a VC. There's lots of different data points that you can utilize. There's lots of different kinds of risk. Smart contract risk is one of them, but also economic attack risk. So things that maybe not be a bug in the code, but actually just a bug in the economic system, and kind of talking ourselves. And we had people that we knew that were highly, highly attuned to different economic situations that these things could be exposed to. I think even Gauntlet was launched, a company to basically pressure test these DeFi protocols. So we look at that. We would obviously look at Lindy, how long it's been around, its TVL, how concentrated it was. VC backing helps, obviously, because a lot of due diligence was happening, but because we would put significant size into these things. So we'd always talk to the founders, get a sense for them. But yeah, it was a good time to be in the DeFi yield farming space.
Nice. Cool. I want to talk about what's on top of every crypto investor's mind is regulation, and hopefully clarity gets through Congress this summer. Genius being signed last year, first federal stablecoin framework. Could you just talk to me in plain terms what you think is the biggest potential outcome from clarity? And in your mind, does it do to move the needle? And where does it still fall short? There have been a number of other bills that have been proposed in other subcommittees more recently, but this is the top of mind for the industry.
Yeah, I think the regulatory environment kind of segues quite well into how I got here and becoming a VC. So post Accomplice, basically the entire market reset, and that was when in VC and crypto, as we know, you build in the bear markets. So a lot of VCs raised a ton of money in 2021, 2022 that weren't doing very well. And ultimately, I thought, now is the time to get into this space. Like I mentioned, I've been in the space for 13 years and my network runs deep. And so I went to a lot of different crypto OGs. Some of our LPs are like Kyle Samani from Multicoin, Nick Carter from Castle Island, Jake Bruckman from Coin Fund, Rob Haddock from Dragonfly, early employees of Figment, obviously Circle, and a number of different people who have been in the space. And so went out to all these guys and we raised our fund. And then, fund one crushed it. We're one of the top performing funds for our 2023 vintage. It was definitely hard raising it post FTX. I basically did the fundraising between Luna and FTX. And I think back then, the token play, it's weird with kind of clarity and the kind of what the regulations coming out and how founders have been kind of forced into a box. So we had Gensler during the Biden administration, and there was a lot of basically dancing around the equity type behavior of a token where value can accrue to a token from a protocol. And so a lot of hoops were kind of jumped through to make them less equity-like, to not violate any kind of securities laws. And that's what Clarity is here for. We look at like a Hyperliquid or even a BNB that do buybacks with revenue from the actual protocol. And there's a lot of offshore strategies, but what we're seeing with Clarity is now we are actually going to be able to bring value that's accrued by the protocol to the token without like giving quote unquote governance rights or other types of rights. So I think that's going to really clear up things for founders and investors. And instead of having like this big question mark over what's the best model to launch a token and like how does it accrue value, like we're going to have a defined framework from the US government on how to do this. And so it's going to really invigorate the US crypto market, the US digital assets market, bring founders in and more investment in. So I do think it's one of the most bullish catalysts that we're looking forward to. I just got to get past. I think our timeline is kind of short. So I think it needs to get past within the next month before we start having to worry about the midterms. But it's looking good. I think Polymarket has it like 50, 60% right now. I'm not sure actually the last number.
Yeah, a lot of distractions in the world for regulators, but hopefully they stick to their promise and give us clear set of rules to operate in. I think it's been really interesting to see too. You mentioned Gary Gensler. The CFTC and the SEC historically do not collaborate. Over the last few years, there's been a lot of more government collaboration because in those early days, it was a huge gray area. It's like, well, who's regulating this? And there were 4 or 5 different agencies or different individuals that say, oh, that's our jurisdiction. Now, this will really give a clear oversight on, hey, X person is in charge of these rules and enforcement, which I think is going to be extremely helpful. And during those Gensler years, there were a number of funds and projects that said, we're moving our office to London, right? A16Z and others made those announcements. And I'm hopeful we can keep that innovation onshore. It's very unlike America to be moving behind Europe in terms of innovation. But Mika beat U.S. regulators to the chase, and hopefully we'll catch up. Speaking of that context of regulatory bodies, specific to your deal flow, how you think about making investments, where do you think U.S. founders are genuinely winning in DeFi and real-world assets right now? And where are they still losing ground to offshore teams? Obviously, Hyperliquid is an offshore phenomenon, but specific to your portfolio and how you're analyzing deal flow, how do you think about that?
Yeah, the token game has changed, and I think it's very healthy for our industry. So the whole thing for many years is we had a lot of founders that were short-term opportunistic, extracting value from the crypto ecosystem and the liquidity that's in our space. And so the old game of like, hey, we're going to launch EigenLayer, but it's going to be on Solana, and we're going to launch a token in 6 months that's going to pump and everybody will be very happy. That game is done. And frankly, like even if looking at those opportunities, looking at those investments, that's not why I'm here. And I don't think that's why really anybody's here, at least on the VC side, because we're long-term investors. My fund is 10 years long. We're not just going to be like quick pump and dumps, like token things. So the whole thing of like launching a successful protocol on another L1, it's just like, it's over. And I'm really happy it's over. So what that's done in this market over the last year, maybe since October, it's really thinned out the herd of founders. So the founders who are like, hey, I can like pump a token are like leaving. And so now we are left over with the founders who have conviction, that are real, that are here for the long term, and they're building protocols that actually do create revenue. It's not just a token that, retail buys or whatever. So, which is a breath of fresh air. And that's something we've always focused on at Breed. Like I said, our fund was one of the top performing funds for our vintage. And we have 5 unicorns. The strategy on actually backing real founders who are building value has worked for us. There are some other investors, VCs, who are more short-term. Maybe they launch like a 3-year VC fund or a 5-year VC fund, and they're forced to get that exit liquidity right away. But it's a breath of fresh air. We're seeing some really tier one founders. And I guess the second order of effect of this kind of shakeout of founders and even VC dollars is valuations have come crashing down. You used to see like a tier one founder raising at 60 million, 80 million, 100 million valuations. Now it's like 10 or 20. So it's a really good time to have dry powder and be a venture investor in the space with a long-term vision. So yeah, we're really excited about what we're seeing out there. We're seeing some really good stuff, some really tier one founders. And it's like, I think it might be hard for like the liquid traders that are watching the token price go down. And I think a lot of people over index on crypto Twitter and like people being upset, but our industry, we got everything we ever wanted. Right? We have an administration that's very supportive of our industry. We have clear regulation coming out. We have institutional adoption. We have product market fit, specifically with stablecoins, also with other real world assets being tokenized on chain. We're seeing a tokenization of the entire financial system being supported by governing bodies with clear regulations. It's like, we should be really happy. Yeah, the Eigenlayer and Solana didn't pump. Get over it. Right. So like that's kind of what we're seeing. So yeah.
No crying in the casino, as they say. Right?
Exactly.
I think there's still some of that Copycat launch a new chain. You've seen it recently with perp dexes. The liquidity hasn't really shown up outside of Hyperliquid, a select few other venues. But what you're alluding to is very true and not happening anymore. It used to be a great founder builds a product, and then all of a sudden there's 7 copycats comparing the token value to this great project and trying to do that just on a different chain. That's, certainly been flushed out. There is, to some extent, a liquidity dispersion when that occurs. It's happened in prediction markets. Polymarket, call sheet. Is that going to happen in perp dexes? Time will tell.
We really do focus on the psychology of the founder and who the founder is, what their motivation is and why they're here and background and their trauma and what keeps them up at night. And what I'm trying to get to is the idea we back typically ends up not being the idea that gets built. These founders will pivot 3, 4, 5 times and before they find product market fit. And so what we're really testing for is who has the grit and the motivation and the incentive to keep going during those super dark times. I was a founder myself and building a team, waiting for that next check to come in from some sale you're trying to get to make payroll. All your friends having a really cushy job at a large bank, getting paid more than you. Maybe they have a better title. A lot of founders can't deal with the uncertainty of starting a company. Because you don't know, you might be working for 3 years, 5 years, 10 years, and at the end of the tunnel, there might be nothing. Humans cannot deal with that uncertainty. And that's what we're really trying to figure out is how long people can deal with the uncertainty to get through to product market fit. We do that by a number of different ways. Obviously, our calls with founders, but what I found is the best way to kind of get to the bottom of who a person really is, taking them out in person, drinks, dinner, that type of thing, getting them to really kind of open up to realize if this is person something that we want to back.
And are there thought-provoking questions in that process that really allow you to dig into a person's mindset and how resilient they are? Or is that more pattern recognition of their life experience to date, right? Is that having a failed startup before or having an exit? What are some of the questions that you ask to really drive down this person's going to handle adversity and keep their head up and keep going?
Yeah, so there are different archetypes of founders that, there's no guarantee, obviously, but certain archetypes of founders that will have better results than others. One of my favorite archetype founders, I like to call like the revenge founder. This is a founder who started a company, maybe raised some money, built a team, and then for whatever reason, they got screwed over by their co-founder or their investors, or their exit wasn't what they wanted. Maybe the waterfall, the investors got paid before him or her, and they just have like this chip on their shoulder plus an incredible fire inside you that you want to like prove the world wrong, that I am the one that's going to be able to start this company. I'm the one who's going to be successful. And the revenge founder is probably one of my favorite archetypes. Backing a founder who's had like a big exit is always like you got to be kind of nervous about because they might be post-economic and maybe not as motivated to make it work. But second-time founders typically do better. But I would say the unsuccessful second-time founders, obviously if there's something they did that was negligent, you don't want to back. But somebody who gave like a really honest shot and didn't get to the result they wanted because they might have been slighted by somebody else is like the best.
Absolutely. I think even the ability to pick yourself up and try again in that scenario is very telling. Do you think you need a bit of ego? Is that chip on the shoulder? Is that a part of it? Or does that not play any sort in the equation?
I think somebody who finds a company has big, crazy goals and they want to be the next Elon Musk. For most founders, it's just like controlling your own destiny is a really key part of it. But we've seen like all kinds of different outcomes with founders and when they fail. I've seen everything from like people being honest and like telling actually why, and they really tried really hard and left everybody feeling good or tried returning a little bit of money. I've seen other people like literally just write a check to them and 3 years go by, their balance sheet, and it just goes down every month by the burn. You literally have no idea. You reach out, they don't even respond to your messages, and you just watch, it's like starts at 4 million and at the end it's gone, all the money, and the person disappears. It's pretty crazy. Now, question is AI the same thing, right? We were super early on decentralized AI specifically, investing in it since 2023. Some of our big portfolio companies have had major outcomes. One of them, which you probably heard of, is called Nous Research. They launched the Hermes agent, which is 5 times more popular now than OpenClaw. So OpenClaw is like the agentic harness that everybody used when super viral, like back in January. Now it's pretty clear if you're going to use an agent harness, you're going to use Hermes agents. So we're back to them. Exo Labs is another one. If you want to run your own models on your own hardware at the edge, you have to use their software, and they have worldwide distribution. Everybody who's running their own models on their own hardware uses them. So I'm just saying, like, we are very pro AI, but it does feel very bubbly. It feels like 2021 on steroids for that industry. Every single seed round is oversubscribed, 100 million valuation for a
Crazy.
seed. Founders are like, cool, you worked at Google for 2 years as like a low-level software engineer, and now you think you could build like this next big company because you put AI in it. But going back to like where this is relevant to crypto is like, how do you underwrite this market? It just feels pretty toppy and bubbly, especially in the venture market.
Absolutely. I think capital is always going to chase returns. So every market at some point will turn over. But there's just so much FOMO. My short tenure as a VC, I've never seen uncertainty across the board for every type of investor. How do you invest for a 10-year time horizon when you don't know what's coming 2 years from now?
The FOMO, I basically have Anthropic saying they're building God, right? So what is God worth from valuation point? And everybody and their mother is like, I don't want to miss out on investing in the next God of Earth. So the valuations are crazy. What's interesting for us as crypto investors is we're kind of contrarian. Every VC family office is trying to stuff money into AI, but crypto is kind of being ignored right now. We're here, we have the expertise, we have the networks, the edge, and the valuations have plummeted to a point where it's significantly easier to have a big return for your fund. A ton of VCs have moved on, and I think that's fine that you need to chase returns. But I think without the edge, I don't know how you really compete and get the best deal flow.
Absolutely. Could you talk to me about your real world asset portion of the portfolio? Many years ago, there was security token hype, and that bubble burst. Do you think real world assets to some extent are reshuffling or a wrapper on that? Or what has fundamentally changed from those days to now?
Yeah, I think the tokenization of all financial derivatives and instruments is clearly happening. I think it's kind of the second major kind of product market fit that we're seeing. First with ETFs, that'll kind of treasuries all being on chain. What's changed from the security token phase from a few years ago is clearly regulatory and institutional acceptance and adoption. We have CFTC, SEC administration, we have Genius Act, hopefully Clarity Act. It's clearly a category we're excited about, pretty active in. I think you guys had 3F on a previous podcast, who's looping of LP positions for funds. So that's like pretty cool. We've seen like tokenization of mineral rights, of power contracts. There might not be demand, but clearly there's demand for a lot of these things for the world. The whole world wants access to the US stock market. Somebody in a developing country, Africa, wants to invest in Tesla or Apple. It's really difficult to do, but you can do it on chain now, and even get leverage on that. So I do think there's a lot of demand. The first instrument that gave the world access to the US market was stablecoins. And now what's the next thing with stablecoins? They can get access to our equity markets. And then going even further, we have these companies staying private for so long that it's getting crazy. SpaceX launching IPO in, I think, 4 days from now at, I think it's 1.75 trillion. All the juice of that investment is kind of squeezed out by private investors. And that's not how it used to be. When Google launched their IPOs, these were in single billion-dollar valuations. And people who bought in crushed it. Now they're trillion-dollar valuations. But because of the dynamics of the market, pre-IPO stocks, I think, is a key category. Now the question is, like, structurally, how does that work with SPVs, with rights to the shareholders, preferred versus common stock? All these kind of different things need to be figured out. I think they're being figured out, but there's clear demand from the world for different assets. And we're seeing institutions and regulations lining up with it.
Yeah, it's interesting to see because a lot of the new net buyers for BTC are institutions, institutional capital coming to the table. And you talk about pre-IPO access to Mag 7. The demand for that is largely emerging markets and offshore. And Hyperliquid's a great example of that. It started offshore, retail focused, a lot of degen speculators, and it's slowly transitioning, in my mind, to an institutional product. Being able to trade oil perps 24/7, 365, institutional oil trading desk is going to find that very attractive. An individual retail trader isn't necessarily looking for oil hedging tools in their personal portfolio. It's a new paradigm at the moment. Institutions in US, London, Singapore have woken up to this tech, and emerging markets see the value, and it's all driving together. I think that's the main reason why these, real world assets theme has showed up. We just talked about how AI is eating at a bit of everything, especially in tech. What changes with analyzing a founder when they theoretically have every technical capability at their fingertips? How do those dynamics shift from your perspective?
I think the ubiquity of software engineering talent now being vibe coded might be a little overblown. I think it's great, but I ultimately think the people this tech is helping the most are engineers already. So who have some basic, know how to code and develop various applications and products. It turns them from a 1 to 3x engineer to a 10 to a 30x engineer. The thing is, the skill set needed to start a company and actually just building a product are two different things. It's very rare to find a founder who has both sets of skills. So I think it's great that people can vibe code an application, no problem, but actually building a company, hiring people, motivating people to work hard for little pay, for a big goal at the end. And then the biggest thing is sales. So being able to sell your vision, sell your product to people, sell your product to customers, sell your product to VCs, I think is very challenging and not going to be replaced by AI for quite some time. I think it's really important and a great result that we're not so dependent on engineers, and the market kind of reframed that. So we still obviously care about tech talent and look at that pretty deeply, but we're still really back at the CEO basics of, will this person be able to found a company, last, pivot, and figure it out?
That's a really good point, because at the end of the day, the ability to sell is what gets early stage startups off the ground.
Yeah. When you get on a call with somebody and you get excited about the idea, about the founder, like, that's great on the call, but a really good test is like 2, 3, 4 days later, is that founder still keeping you excited? Because you kind of let that initial spike happen during and shortly after the call. But after you have some time to think about it and to due diligence, I've talked to founders before where I just can't stop thinking about them. And like, I think this is the next Elon Musk and I need to be part of this. That's like really good indicator.
Absolutely. Let's dig into what Web3 VCs actually do. What's the fundamental difference between a Web3 VC and traditional VC business model in your mind? Is that just the difference between token and equity, or other dynamics that are crucial?
Yeah, it's funny. If you asked me 2 years ago, I would say understanding token dynamics, tokenomics, retail demand, listings, market making, KOLs, all this stuff. How is this token going to perform? That was 2 years ago. things have kind of shooken out where the token model's kind of broken. The deals we're seeing are more fintech type of real revenue type of businesses and not tokens. It's become much more like a Web2 VC. Back to basics. You can't just be like, this person knows how to pump the tokens. I'm really happy that's over, but you never know. Like tokens could come back huge, and I love tokens. Like that's why a lot of us are here. Web3 VC is like become a bit more traditional. I think it's a good thing, especially for long-term investors.
Absolutely. Could you talk to me about founder market fit? A founder starting a payments company coming from the payments, in my mind, they're light years ahead of someone trying to understand the market, identify problems, and then build. Ultimately, when you solve problems, value will accrue. But the process of identifying a founder market fit, how do you think about that?
Yeah, I would say like another really strong archetype and signal for a strong founder is somebody who's had that specific problem in the past that they're trying to solve. So yeah, somebody who works at Stripe, maybe they saw, wow, it's a really big headache to send dollars to Pakistan. And there's a huge demand for dollars in Pakistan because you have all of these people who are contractors and they want to get paid in dollars. They pay a huge fee and there's like 6 days to get dollars into their bank accounts and nobody will bank them. This is like actually one of our companies called Pocket Money. And he was actually ex-Block, not Stripe. Seeing that problem, experiencing that problem, taking that problem apart and actually wanting to solve that problem is like you're head and shoulders above somebody who's like this is kind of an interesting space. I like it. Like what problem can I solve? So founder market fit, somebody who's experienced a problem and trying to solve that problem and has passion around that problem is really key.
Awesome. When a project claims top tier VC backing, what does that actually signal to retail?
Brand name top tier VCs like Dragonfly or Paradigm or A16Z. These are actually pretty significant signals because they obviously did their due diligence and that's important, but these VCs do have a lot. They help a ton, help their founders. And that's why a lot of these founders, they could easily raise money from a family office, take money from VCs because it's significant help. First, you have the brand power, which is great, the media, but there's like a secondary thing, which is like the connections, the Whisper network, like having portcos that can be potential customers or co-investors, or even just like talking to the right people about this founder of this company. It's huge. So having quote unquote tier one VCs is a great signal for retail, for investors, and not just like tokens, but equities.
Great. What are 3 metrics retail should always prioritize or check before entering a Web3, the top 3?
Say token float, how much of the supply is circulating. 2 would be lockup schedule. When are VCs, founders, angels, whatever, locked up. 3, I would say doing some sort of analysis of social media, figuring out who's talking about this on social media. Yeah, I'd say those are the top 3 things.
You've survived 3 crypto cycles. The common wisdom, and we've talked about it today, is builders stay, tourists leave. But the honest reality is even some great builders quit. What's the behavioral signal tells you a founder will still be building when the market's down 90%?
Yeah. So I've been through the 2013 cycle. There's a lot of different coins launched then. 2017 ICO, obviously, bull cycle. 2021, 2022 DeFi, NFT. And arguably, we just went through a cycle, right? I don't even know what to call this cycle. Maybe the Trump cycle. But funnily enough, typically people have been in the space for a while and building will stick around and things are down and like they're all in. But there are new people to the industry each cycle that come and crush it. A perfect example is Guy from Ethena. He was like at a traditional hedge fund, joined the industry in like 2023, and he didn't have much of a crypto background. He was inspired by the Arthur Hayes post about putting the basis trade on chain. A lot of founders who have fresh eyes and come to the industry and can build some major things. Leaning too heavily, like, hey, this person's been here since 2015 or whatever, that's not a good reason to always back them. Fresh eyes are really important.
Nice. Well, Jed, it's been an absolute pleasure to chat with you today. I've got one last question for you. Be bold with this answer. 10 years from now, does the line between TradFi and DeFi disappear into a single global liquidity layer? Or do we end up with two parallel financial systems running forever? And where does the US end up in that picture?
That's a good one. 10 years is a long time, and people underestimate what can happen in 10 years and overestimate what can happen in one. Depending on the various administrations over the next 10 years, let's say we go to a supporting administration, supporting regulatory environment for 10 years, I think it all merges into one. If we don't, we get two. I think it just really depends on the regulatory environment.
You think that pendulum swings back and there's another crackdown?
If I was a betting man, I think the pendulum swings back and the regulatory environments tighten up as the political spectrum goes back and forth. So I think it's going to go back, which is not
Understood.
bullish,
Well,
but realistic.
I think the foreseeable future, hopefully the pendulum is not going to be swinging too far.
Having two different financial systems that are institutionally accepted and regulated, I think, is a great outcome as a base case.
Absolutely. Awesome, Jed. Thank you so much for taking the time today. I really appreciate it. And thank you all to those that tuned in, and we'll see you soon.
Thank you, Jeremy. And thank you, Gate Ventures, for having me. And you can check me out on Twitter. My username is Jed Breed, JEDBREED. Check out Breed VC at our website, breed.vc. And yeah, I'm pretty active on X, Twitter. Feel free to reach out to me there.
Perfect. Jed, I think you're one of the best VCs in the industry. Thank you again for taking the time. Talk to you soon.